This is Abhijit Chatterjee. Welcome to our weekly session of Chartsarefun. This is for the week of October 13th, recording this on Sunday, October 19th. We know that the previous week we had kind of a China tariff-related scare in the market. We had a very sharp sell-off in S&P 500. People were thinking of a further pullback into this week. And then, yes, this week was more of added concerns from Jamie Dimon, the CEO of JP Morgan, statements during the earnings call about cockroaches in the regional banking, the private credit area. And we know that there's been two failures, big bankruptcies in the month of September. First one was Tricolor. It's a Dallas-based kind of car dealership that also was giving auto loans to the immigrant population. That declared, they had relaxed standards in how the loans were being issued. Turned out to be quite a bit of fraud in that business, and that impacted a couple of regional banks that declared it in advance after Jamie Dimon's comments. They came out clean and declared concerns of having to take losses. One was Zions Bank that declared on Wednesday, and then the day after, it was Western Alliance. So this kind of Jamie Dimon's comments and those two regional banks declaring some form of losses from Tricolor and First Brands, which is the auto parts dealer, had shaken up the market. So KRE, the regional bank ETF, took a deep cut, then recovered on Friday. So we'll keep it simple. We're going to look at what that shakeout volatility spiked up. Actually, VIX shot up all the way up to towards 28. So we'll look at KRE. We'll look at how the regional bank ETF performed. We'll look at S&P 500. And interesting enough, a couple of patterns have evolved with one on Barron's and then one on Twitter. We're going to show both those patterns that were highlighted by technicians and what that means for S&P 500. Also looking at some of S&P's indicators, such as its bullish percent on the number of percent of stocks with bullish looking charts from the point and figure perspective, the summation index, and then the the oscillator. And then we will look at gold. We know that gold's been in the news, going up like no tomorrow, but then late in the week we got a bit of a pullback. So we'll look at that. We'll see what does that pullback indicate. Is it something deeper coming in the near horizon? Warren Buffett was also on the YouTube video talking about cautioning investors on gold, kind of bringing in a lot of retail investors and to be cautious about this extremely parabolic vertical climb that gold has had. And then we'll end with cryptos. In particular, cryptos had a kind of a rough week last week, but the Ethereum, Solana, and Bitcoin, three different cryptos that have a lot of investor interest out there. We'll look at all three charts and then show that perhaps some form of a near-term double bottom formation is happening, a W-shaped double bottom, and maybe some recovery rally is expected in the next few days. So this is our website, Chartsarefun, substack.com. It's a blog site. We publish blogs in the morning. Appreciate you subscribing to it. If you share your email, we'll send it to you as soon as they get published. Our YouTube site is Chartsarefun. Appreciate you subscribing to this channel as well. And then if you like the videos, appreciate you liking the hitting the like button. So we talked about the regional bank ETF KRE. This is the S&P regional bank ETF, and we can see these two sharp drops in the candles on two successive days. This is on Wednesday and Thursday before getting a bit of a recovery. But what's key is technically, when you get a lower low from 60.16 towards the 57.55 and RSI prints a higher low, that's a bullish sign in terms of a potential reversal pattern. So that's a positive divergence, something we got to watch and see if we can muster a bigger bounce from here. Another key is a level from the early August timeframe, August 1st, was 57.43, in spite of the scare of two big, like two regional banks, Zions and Western Alliance, declaring losses from their fraudulent. They were all both with the Cantor Group, where they claimed fraudulent transactions, and Cantor Group was then tied up to the two big collapses, bankruptcies in September, as I said, Tricolor and First Brands. So the fact that it printed a higher low, 57.43 versus 57.55, the fact that when it printed a lower low from 60.16, a higher low in RSI, capitulation volume on the drop on Thursday indicated that potentially we might have put a near-term bottom. Bulls would say potentially this is a head and shoulder pattern, maybe 57.4, 57.5 is the neckline. Joining that level, we have the left shoulder from 57 to 63, then 57 to 66 is the head. So another pull up towards the 633 level, which could retest that 50-day moving average, is where maybe the right shoulder forms and then a breakdown. So that's something for us to watch. You could also, we published in the blog, think of this as an inverted cup and handle. If you take the brim of the cup at 60, we know that from the like first week of August, from 60 we went to 66, down to 60, then a handle from there to 63 and the breakdown. If you consider that as an inverted cup and handle, then that 60 to 66 is like $6, and then from 16 to 55 you're talking about another 39 cents. Subtract that from 60, so it's like $53 something, which is like the level that we've seen here in the May timeframe. So that's bearish possibility that if we do fail, because right now we had a rebound testing that 200-day moving average, which is right now, as you can see, at 59.34. The high was 59.26 on Friday. So if that fails and this week we continue to drop, then potentially there's a possibility that we could come down and test that 53 level from that inverted cup and handle. But near-term possibility is that maybe this is a bullish sign, this positive divergence with lower low in price from 60 to 57 with a higher low in RSI. Maybe the rebound goes a little longer. Now, S&P is on its hourly chart formed a key shape called a pennant, which is really a consolidation pattern. It means it could kind of either break down higher or lower. Bears would point that, well, look at the 50-period moving average kind of converging, about to break below the 200. The 200 is rising, though often when you have a 200 period that's rising and the 50 crosses below it, that's a false signal and the 50 could resume its climb, is a possibility, is what the bulls would point to, until the 200-day plateaus out and starts coming down. When you have a kind of a declining 200-day moving average, and then you have a bearish cross of the 50 below the 200, that usually means a bearish sign. So we'll see. There's a possibility that if this breaks higher from the pennant, then we could go retest the previous highs from the October 9th or so at 67, 64 and break out higher. We've talked about previously a cup and handle on the daily chart, pointing us to a target almost above 7200, 7283, closer to 7300. If that's the case, then yes, the 6550 to 67, that would be a kind of $214 at 214 to 67, 64. That can get it closer to 6900, and then a continued climb is possible. But if this breakdown from this pennant is to the downwards and we get a bearish cross and the breakdown is below that, then you are looking at a potential head and shoulder pattern. And that's what was pointed out in this Barron's article. Actually, it was CBS Marketwatch, not Barron's, that there is this pattern that since the April low, S&P prints two successive highs, but then holds that key support level. So we can see that from the first high, it pulled back to test from where it climbed. Then it put the second high, but then it broke higher. Again, two successive peaks, one above the other, but then holding. In this case, it pulled back to test that support, and then from there reverting to a higher high. So this is now the fourth time that's happening. First, second. So first one was about the May towards early June. Second was through June through July. Then it was through late July into August, and then more recently into September and into early October. We saw the double peak test of that key support zone. So if that support zone holds like it has held in these three instances or four instances and starts climbing, then that's a bullish pattern, and that's possibility is what some technicians like this guy Frank Capillari is looking at in the CBS MarketWatch article. However, the head and shoulder is this pattern that we were discussing. The neckline is right at 6550. So you have the left shoulder here, then the head, and now a right shoulder. If that breakdown happens from a 67, 64 to a 6550, you're talking about 214 points. Subtract the 214 from 6550, and we talked about this last week's video as well. That measures closer to 6330. 6 or so. So that's potentially where this head and shoulder could resolve, and we got to see if that's a possibility. Now, there's a technician in Twitter who you often posts, and he is bringing up a very interesting point that there's a lot of similarity. There was a head and shoulder breakdown, but that was a fake breakdown. It broke down in the December timeframe below the neckline into January, but then it quickly recovered. It didn't quite fully meet the target of the head and shoulder. There was negative divergence there in RSI as the left shoulder to the head formed. Similar kind of RSI negative divergence as left shoulder to the head is formed. So if we do get a breakdown, we may only get a temporary pullback from that neckline. In this case, the neckline is at 6550. So we might get to maybe a 6500. Just like here, we saw a fake out, a breakdown, but not quite the full breakdown, and then it recovers. So he is pointing out that maybe we could recover from here yet again with bullish momentum. Maybe the regional bank crisis that we just saw is going to resolve out in a positive fashion for the time being. There is more bullish momentum. Usually from late October into November, December, market sees bullish seasonality, and maybe we climb back up to all-time highs. So there's a possibility. And we know that the biggest thing that's favoring the market as a tailwind right now is the rate cuts. We've had a rate cut in September. This is the second series of rate cuts. We had rate cuts last year in September and then October and then in the September, early November, and then in December. And then there was a pause, and then the next set of rate cuts started in September. We've had a 25 basis point, another 25 expected later in October, and then one in December. So with the rate cuts, perhaps it acts as tailwind and helps the market move higher. We know that in a shutdown, we don't have enough data. So there's a possibility that market is still going to be anticipating negative data. But if there's not much data on the employment front, of course, we don't have any data. This Friday coming up, however, there is expectation of a CPI data to be shared by the government. So we'll see what that CPI data prints. If it is, oil prices have been shooting lower. So if oil price is shooting lower, in many ways, inflation is linked to oil prices. There's a good chance that inflation may not tick up as many are fearing, and in that case, helps the Fed go in and do their rate cut. So with that, with a rate cut ahead, possibility of what Heisenberg, in this case, the Twitter handle on X is tweeting, there's a possibility that another false breakdown could come exactly like it happened in the December to the January timeframe, and going into November, we see all-time highs, and this time maybe go all the way up to the target that we're talking about, closer towards 7,300. Now, if you look at some indicators like the bullish percent index, in many ways, yes, it is similar. So like right now, bullish percent index from 54, fell down to lower lows at 49.8. But look at RSI, it's at a higher low. So that's positive divergence here. And look at what happened in that December timeframe. From the 70s, it kind of fell up to 38, and from there recovered back to 56 from deeply oversold levels. So possibility is that maybe we are setting up for another recovery of bullish percent index as the market recovers, and then it forms a lower high. So maybe we go some more, another drop or so, because remember, in this pattern, there's still expected drop from that neckline, and we closed pretty much above 66.64. So we could come back towards 65.50 and have a bit of a shakeout, drop maybe towards 6,500. So another 150, 160, 70 points. A breakdown means bullish percent index could drop further, maybe towards that P38 level, hold the support, and then from a recovery to that 55, 56, which we can see here is right now the 50 period is now getting to cross below the 200. So in that sense, that could then lead to a lower high from the previous highs hit 61 to 63, and then a pullback. And that's like when the February drop happened. And that's when perhaps after market achieves a higher high, which is what in S&P did in this pattern here, that it kind of had eked out a slightly higher high into February, didn't go a lot higher high from here, but slightly higher high. And then from there, it collapsed into from February 18th onwards. Maybe we kind of get that after we print a higher high. So that's what Heisenberg is talking about. And bullish percent index in many ways is mimicking what happened in the December to January. We'll have to see though. And then summation index, we can see, which is a market oscillator, is deeply oversold for the New York Stock Exchange. It's the NYSI, New York Stock Exchange McClellan Summation Index. We can see that the RSI is at 7. Similar kind of deeply oversold levels we got into December into January. And then from a recovery of that oscillator, got the market to have, recovery from that early January kind of a low. So possibility is with the deeply oversold oscillator, we could perhaps have a recovery, and then with that oscillator recovering up to the 70 level, we could have a market maybe break out to higher highs. And then the oscillator, which is the NYSE McClellan's oscillator, which is called NYMO, printed a very extreme oversold level at minus 71. It usually fluctuates from 80 to 90 on the top to the minus 90 to minus 100 in the bottom. We didn't get as deeply oversold as in December. This was minus 106. We got an April low at minus 90. This was a higher low at minus 71. And from there, we recovered towards minus 1. We didn't quite go to the positive. We're still in the negative zone, minus 25. Maybe we have a higher low. Maybe we from here test at minus 51. By that time, we have a fake out with the S&P going right below the neckline, and then we have the oscillator go back towards the positive level, just like we had from December. We noticed that from that the extreme low, we oscillated all the way to 81, and then from there it printed a series of lower highs before we broke down from late February. So maybe we have an oscillator go back towards 80, and then a series of lower highs form as the market kind of tops out and then starts dropping. So that's a potential possibility. Looking at the summation index, maybe reverting from a deeply oversold level, and then from the oscillator, maybe a pullback to minus 51 and a recovery higher means the market could have a recovery. Now, I'm going to go into gold, having talked about S&P 500. Heisenberg, the technician, also showed a very interesting trend line going back towards 1987. And we can see that if you join the peaks of gold in 1987, 2011, and the most recent peak that we saw this month in October, that's a kind of a straight line trend line, and spooky that that trend line is joining from what happened in the October of 1987, from where we got a sharp pullback in gold as the market sold off. But it was not just a kind of a 1 or 2 month, it was a multi-year breakdown, similar multi-year breakdown. When you have such kind of extreme parabolic climbs, it's usually a multi-year breakdown. So that means if you listen to Warren Buffett's YouTube video, if you Google on it on gold, you'll see that that's what he's talking about as well. He believes that this is like extreme retail euphoria on gold. Central banks, yes, are diversifying out of dollar, but gold as a precious metal is just a sentiment-related buying. It's not really a growth. Like people are now lured into thinking that it's like a growth stock, it'll keep growing up to the moon. It cannot, because it doesn't generate revenue. It's not generating dividends. It's not giving you dividends. It cannot grow in essence. It's essentially what the humans are willing to pay for. And right now, the retail investors are being sucked into Warren Buffett, just shooting it higher, chasing it higher, which then they can get hurt really bad, as we can have a repeat of what happened in 2011, or as shown here at Heisenberg in the 1987. So this is definitely a concern of gold testing a very key trend line. And then if you look at the gold's like yearly chart, every candle here is a year going back all the way from the 50 year plus from 1969s. We can see that if you do the 2-year rate of change, as in over 2 years, what's the percent gain that gold has had? Gold right now has come up over 106%. That means it's more than doubled in a span of 2 years. The previous 2-year rate of change, as we can see in the 2020, was in the 50 level. And then similar in 2010, 2007, and then 2003, it was typically in the 50 to 60 level and then pulled back. It never went up to 100. This now is getting closer to what happened in the 70s. One was in the mid 70s and then into the late 70s, 79. There it went up to 200, close to tripling of gold. But that was from much lower values. Tripling made sense. From here, we are basically from what we were at 1600 have gone to 4300. But look at how the month so far has panned out. Last week, we said we did get a pullback. So 43.79 was the high of last week. We closed from there 120, 30 points lower towards 42.50. We got to look at the rest of the month in October. Warren Buffett is claiming that we could get a pullback very soon. And in that case, if the parabolic drop of gold happens, is something for us to watch, because look at how extreme overbought RSI is at 90, as we've seen in the past year in 2011. So in many ways, extreme overbought levels in RSI, a very vertical parabolic climb, MACD extremely overbought, and from rate of change over 2 years at 100%, 106 at doubling in gold in 2 years, means that aggressive rate of growth means we could be prepared to see a multi-year pullback. So we caution again on that. We're going to end with cryptos. Interesting enough, Ethereum tested a higher low from what we saw from the early part of October. That was at 35.46. This was, by the way, the low Ethereum saw the day the cryptos had a crash after on that Friday when President Trump talked about the 100% tariffs on China from the rare earth kind of trade war that started 2 weeks ago. So that it did not last week cross below it. It was a higher low, so that's a bullish sign, a W-shaped double bottom, but a higher low from the previous level, 35.46 to 36.75, and then trying to recover. We'll see if it is then able to, if it's a W-shaped double bottom, expect it to take off that 42, 4,300 level and print back towards 47. That's what the bulls would expect. So if you can get a 35 to 47, you're talking about $1,200. Add 47 to 1,200, you're getting a 5,900 towards 6,000 is where bulls would want Ethereum to go. Solana, similar kind of higher low from the previous tariff, the Friday's President Trump's 100% tariff on China news. So 172.85 versus 174.16. Again, a bullish higher low. Tested that rising 200 period moving average successfully, recovered from it, and so far trying to recover. If that's a W-shaped double bottom in Solana, then expect 172 to 211. You're talking about roughly $39. At 39 to 211, you're talking about 250. So that's where closer to the previous peak that we saw in September, 253, that's potentially where Solana could climb towards the 250. And then Bitcoin, interesting enough, did not meet the other two, which had higher lows. We can see that Ethereum had a higher low. We can see that Solana had a higher low from that trade war Friday's crash. Bitcoin, however, had a lower low. So Bitcoin negative momentum is still there, but in both lows, look at the recoveries. That means smart money buys when get the opportunities of these price drops lower. So at 105 to a 103.6, either case left a long tail in the candle, means crypto's recovered. Right now, if that's a recovery and we start posting higher, then we wouldn't be surprised to see this break 126 and print higher highs. So that's what we're going to watch. In summary, we had a regional bank scare. Jamie Dimon, CEO of JP Morgan, talked about cockroaches with the private credit related risks everywhere. And then we had two regional banks, Zions, and then, the Western Alliance talked about taking deep losses, $50 to $100 million losses because of the fraudulent auto lenders and auto parts supplier. The S&P 500 on its hourly chart shows a pennant. So we expect a resolution in the next few days. Either it's higher, then that's bullish. If it does break down, we can watch if this turns out to be a head and shoulder breakdown. The head and shoulder breakdown, as we show here, if it breaks below that 65.50, can go to 63.36. This gentleman, Heisenberg, on Twitter is talking about potentially a bullish resolution of fake outs. Yes, we could get a breakdown, but not go to 63.36. Maybe have a higher low towards 6,500, and then from there, just like have a new all-time highs, like we got new all-time highs here in the December into January breakdown into a February high. So that's something to look at. And the other key thing is VIX chart. We can see that VIX shot up in this particular case to 28. Very similar situation. It shot up and then it quickly came down. Same thing, it shot up to 28. That matches the December shoot up. And then look at the end of the week, we were down towards the 20. It ended towards 20.7. So VIX, if it now starts a downward trend, goes back towards the, 15, 17 level, and then kind of is range bound there, like we saw here, 20 to 25. That's a potential possibility where we could see a recovery into new highs of S&P. So that's worth watching. The bullish percent index is similar, kind of maybe another drop comes as we get a fake out break below that neckline towards that 38 level, and then from there a pullback to a higher low at 56, and then maybe after that new all-time highs is formed is when we do get a breakdown. Yes, eventually we are looking for a potential, having a long climb from April. We wouldn't be surprised to see some form of pullback into December, into January. But for the time being, maybe a repeat of what we saw here into December, into January to higher highs in S&P is a possibility, as shown by Heisenberg in this particular tweet. And then summation index is extremely oversold, is why we feel there's a possibility of a market recovery. RSI is at 7. From here, it could recover. But again, a pattern of lower highs is performing. So even if it recovers, we expect it to fail in the 50 period moving average in the 400 level, and then kind of resume to have lower lows. So that's where we think the pattern of eventual drop is going to come. The oscillator from an NYMO, the NYC oscillator, we could see an inverse head and shoulder from the -1 pullback to -51 for the next few days. And then that's by that time we have a fake breakout down below that 65.50 neckline. And then from there, recovery to higher highs, and then go back to the positive like we saw in December to into middle of January. So a higher high towards 81, and then maybe a series of lower highs as the market tops out over the next couple of months. Gold, extremely cautious. Look at it testing a major multi-year trend line, 1987 peak, 2011 peak, and the peak we recently got. In all cases, vertical climbs and then multi-year, sell-off, multi-year sell-off here. While they say it's different every time, and that's what Warren Buffett said as well. When everyone says this time it's different, remember, it's investor psychology is never different. We are all humans. Humans repeat psychology. Same thing is happening. This is not smart money buying. This is retail chasing and causing this vertical. So this is smart money distributing into retail hands. Expect a sharp drop over multi-year. So not a time to be long gold. Be very cautious and start thinking of profiting or taking your profits on gold, and then kind of holding and watching while this pullback comes in. The multi-year trend all the way from 50 years from 1969 onwards, we can see has basically kind of gone in a very vertical fashion. 2-year rate of change is now even higher than what we've seen across all of 2020 into the 2003, 2007, and 2000 10 peaks. All of those rate of change were in the 50 to 60. This is at more than double at 106. The last we've seen such high levels was at triples, but those are from a lower base. They tripled in 1974 and then in 1979. We don't expect we'll get a triple here. We think we are getting closer towards a peak, and then from that extreme overbought RSI at 90, expect a drop. Finally, in the cryptos, Ethereum and Solana look more bullish, higher lows, and W-shaped double bottom could be forming. Looking for Ethereum to climb back to 4,700, and if it can do that, and from there break higher, 35 to 47 is 1,200. Add that, so that measures to closer to 59 or 6,000. Solana, we believe that 172, the double beautiful W-shaped double bottom, the next bottom is higher than the previous bottom, 172 versus 174. If it breaks above 211, expect it to go to 250. 170 to 211 is closer towards $39. At 39 to 211, you get 250, which is closer towards the previous peak we saw in September. So that's where Solana we think is headed. And finally, Bitcoin kind of had a lower low, not like Solana and Ethereum. So from that tariff-related crypto scare that we got 2 Fridays ago, we got a lower low from 105 to 103, trying to recover. So far on Sunday, it's a bit of a sell-off coming in. We'll see what happens in the early part of next week. But if you are able to maintain these lows and recover, then the next level of resistance for Bitcoin is 116. And if it can take 116, 103 to 116 is 13,000. Add 13 to 116, 129. Expect higher highs in Bitcoin in that case. That good luck investing. We'll talk to you next week.